Joining us now for an exclusive interview, former Federal Reserve Vice Chair for Supervision, Randal Quarles. It's good to have you on the show. Welcome.
Thank you. It's good to be here.
It is a conundrum, right, Randy, for the Fed, which is inflation is starting to come down. Fed Chair Powell has talked about disinflation, but as we saw from today's numbers, it's not happening very quickly, and there's still a lot of parts in there that are proving pretty sticky. So what does the Fed do?
Well, I think the first thing you have to remember is that the Fed's policy acts with a lag, and that lag is at least 6 months. I mean, historically, people have thought that lag is going to be a year, even 2 years before a particular policy action flows through to the economy. Now, there's very good reason to believe that traditional 1 year, 2 year lag estimate is going to be shorter in this cycle, and I think that it will be shorter. But even if you assume 6 months, we will just barely be seeing the effect of the first 75 basis point interest rate increase in the economy now. And so the repeated 75 basis point interest rate increases over the late summer and fall will work the way through the economy over the next several months. And I think this is about exactly what we would have expected inflation to be doing now, a little bit higher, but about what we would have expected it to be doing given that lag and given the Fed's policy, if you thought the policy was working. So I certainly think that this is evidence that the Fed's policy is working about as well as one could expect, but it was not until the middle of the summer that we started getting the really robust rate increases, and that will take a while to work their way through.
So if you were still on the Fed, would you be in the camp saying 1 or 2 more 25 basis point hikes is enough, and then we can pause and see what happens?
So I certainly would be. I do think that when you look at the percentage increase in the cost of debt service of short-term debt that has occurred over the course of this period, even though in absolute numbers the interest rates are at reasonable historical levels, it has been a very swinging percentage increase in the cost of short-term debt. And I think that will, as it works its way through the economy, be quite effective. So I would, if I were still on the committee, I'd support another increase of 25 basis points, take it up to 5%, and then pause and let policy catch up to the economy and determine where you go from there.
Oh, so just one more. So does that mean, you're really making the case for the lagged effect of the Fed tightening. Does that mean that you think this whole burst of enthusiasm around the economy, that we might not even have a hard or soft landing, that's not realistic, that we're definitely going to have a recession once the full effect of the rate hikes hit the economy?
Well, I certainly think so. I agree with what Brian Moynihan said just now, the clip that you showed, which is I believed from the beginning of this tightening cycle that you'd have a short and shallow recession. I think that's consistent with with the dynamics of the economy that we're seeing currently. The Fed has almost never, maybe once in 80 years, completed a tightening cycle without triggering at least some recession, and so it would be perfectly reasonable to expect one here, and I do, but I expect it to be short and shallow.
With us, Randal Quarles, the former Vice Chair of Supervision for the Federal Reserve. Do you have any problem with stock-based compensation for executives and share buybacks?
Really, no. I haven't ever heard a really coherent, let alone compelling argument certainly not against stock-based compensation that aligns the executives with the shareholders. And if the compensation committee of a board wants to have a certain amount of compensation in stock, I see no public policy reason that we should be opposed to that. And in fact, stock buybacks, the practice of our large banks returning capital by repurchasing their stock, allowed us to be much more flexible during the COVID event in 2020, when regulatory authorities around the world had to completely prohibit banks from issuing any sort of dividends. And because
Yes.
our companies distribute a reasonable amount of capital through stock repurchases that are variable and not expected, we could close down those stock repurchases and still allow dividends to be repaid. So I see a number of positives to the practice.
Yeah, no, and I'm glad you added the context, because I was going to tell people, you were the bank cop. You were the bank cop on the beat, right, for the Federal Reserve. And that was what you were famous for. I actually, in that conversation with Brian Moynihan today, we talked a little bit about the new stress test scenarios, and he was pretty adamant that, banks are very well capitalized, the industry is well capitalized, we don't need more capital in the industry, and that he's still doing buybacks. And I just wonder if you would agree.
Yeah, I don't think there's any argument there. The banks are extremely well capitalized, and there is, I think the amount of capital is just about right. I wouldn't argue for significant reductions in capital, but there is a cost to too much capital in pushing activity outside of the pretty stable banking system and into the less stable non-bank system, where there are bigger risks to financial stability. So I think you have to think about the whole system when you think about what the right level of bank capital is, and continuing to increase it has costs.
Right.